Today, we are going to be lasering in on an economy that is, to use the technical term, fucked. We are talking about the second largest economy in the world by nominal GDP and the single largest economy in the world if we use purchasing power parity, which is, of course, China. What's up, apes? Welcome back to the 𝗪𝗚𝗀𝗄𝗀 Daily Podcast of the day. Thank you all for joining us here once again on the world's single most influential and popular financial program. I don't know why I said financial there, because it's just program in general. We got a lot going on here today. It was a busy week last week with Fed rate cuts, a bunch of other central banks making moves, choosing to not make moves, as we talked about here in today's edition. Today, we are going to be lasering in on an economy that is, to use the technical term, fucked. We are talking about the second largest economy in the world by nominal GDP and the single largest economy in the world if we use purchasing power parity, which is, of course, China. So we'll be breaking that down in just a couple of minutes here. That's our first big story of the day, and then we'll be finishing things up, talking about some of the biggest stock moves of the day. We got a lot of action going for companies like Tesla. Who else was a big mover on the session here today? GM got slapped with a big downgrade, so we'll be talking about the spread between those, newer and traditional automakers. And finally, we are talking about pigs and pills, because the Denmark economy is really fucking weird. So let's go ahead and get right into it. The WSO Alpha portfolio, this is our proprietary portfolio over here at Wall Street Oasis, so you know that it's obviously bagging millionaires left and right, even though it did slightly underperform today. Maybe not underperform. Let me see what the indices did here real quick. Fuck, I just lost my tab. So the WSO Alpha portfolio is up 30 basis points for the session. Oh, no, we didn't underperform anybody. Who's talking? S&P 500 up 28 basis points for the session. The NASDAQ up 14 basis points. The Dow up 15 basis points. Not that anybody cares. And the Russell 2000 down 37 basis points. Rough day for small caps. There really wasn't a whole lot of big macro news on the day that would be kind of moving these stocks around. It was more so digesting a lot of this data. We're kind of out of earnings season. So it's, kind of a quieter day in markets here. In terms of macro announcements that we can focus on later this week, there's nothing like supremely major that could be like the next shoe to drop or anything. We're going to get an updated GDP growth estimate on Friday, and I believe we're also going to get PCE on Friday this week. No, GDP is on Thursday, PCE is on Friday, so we'll be looking forward to that stuff, but until then, expect a lot of kind of random shit that's just on the top of my mind. And that's exactly what we did here today, talking about China. Before we get into the China conversation, though, let's talk about some of these banana bits. This was one of the most interesting articles that I have read in quite a long time. The CIA is apparently an undercover venture capitalist. I don't really know why I'm too surprised. They basically do undercover everything, it seems like, and steal a lot of Americans' data in the process of doing so. But Sherwood News, this is one of my favorite new media outlets too. Definitely check out their stuff on a regular basis. Bookmark their tab as well. They just published an article going over all the artificial intelligence companies that the CIA is currently invested in. Unfortunately, most of them are private, so unlike politicians, we can't just follow them into trades and, become millionaires like Nancy Pelosi. But I'm sure that when these do go public, there might still be some upside there, or they'll just, maybe we'll just eat the CIA's losses for them as public markets, because that's basically what we're here for. At the same time, U.S. commercial real estate remains on relatively thin ice. There is some scary activity going on in the commercial real estate industry. One of the biggest things and the reason that we're not freaking out about this here is because there's no huge maturity wall. There's not a year or a month or anything that's okay, this is where everything's going to fall apart if debt payments aren't made. There is a growing wall of maturities, but it's not necessarily up to the point where it's structurally significant, at least according to the Federal Reserve, bank regulators, and I haven't seen anybody saying okay, we're completely fucked yet, besides hysterical losers that want you to buy Bitcoin or gold or something like that. Meanwhile, California is living Greta Thunberg's absolute dream right now. They're suing ExxonMobil because ExxonMobil has apparently been a bad boy about its recycling allegations on its plastics. Basically, the DOJ of California is basically saying that plastics produced by ExxonMobil aren't as recyclable as the company likes to make them seem. Can't say I'm too surprised. An oil company lying, deceiving the public? I know it's hard to believe, but that's what California is alleging right now. Micron had a particularly good session here today, despite the fact that there was a cut to its price target. Shares were up more than 2%, leading into its earnings on Wednesday. And that might be the biggest economic release of this week, because the GDP growth estimate is what's this? This is going to be the third estimate for Q3. Oh my god, and this is the last quarter that we have that giant bar. We'll talk about that later on this week, but I am excited about that. Our final banana bit today is that federal judges are very much not happy with the SEC's treatment of digital assets. Now, this is from Decrypt, so they're obviously going to be a little bit more biased towards it, but one judge had literally said that the SEC's approach seemed intent to, quote-unquote, crush the industry. So, obviously, not very happy with the SEC, and specifically Chairman Gary Gensler right now. All right, so those are our big banana bits for the session. Now, let's go ahead and talk about our main story. This is, of course, a China check-in. Usually, most of the time, communism and economic growth mix together similarly, to a similar degree as JFK and Lee Harvey Oswald, if you ask me. They just, they shouldn't be allowed in the same room together, and they shouldn't be allowed on the same street in Dallas together, if you ask me. But China's rebranded kind of soft-core communism is less Lee Harvey Oswald to JFK and more Marilyn Monroe. It's working out incredibly well. Billions of people have been lifted out of poverty since Deng Xiaoping in the 1980s. But it seems like that's starting to slow it down here just a little bit. Now, before we go into this, a couple of I want to kind of set the stage a little bit, because we're saying that China's economy is slowing down. They are still growing much, much faster than the United States. But there is a big difference here. They're growing faster than most other developed economies in the world. Like, still, their targets are like 5% per year or more. And we're at like, if the United States grew anywhere close to that, it would be we'd all be billionaires at that point, not even millionaires. The US is happy when we're growing 2.5% to 3%. China's happy when they're growing above 5% or so. And it might seem like a small difference, but when we're talking about trillions and trillions of dollars, it is a huge difference, at least in the total dollar amount. So China, the second largest economy in the world, the fastest growing developed economy. I don't know why it's considered a developing economy. They arguably have the most advanced technologies in the entire world. Plus, when we look at GDP ranked on a nominal basis, the United States dominates with its 2023 estimate at about 25 trillion or so. They're saying that it's probably closer to somewhere like 27, 28 trillion for 2024, which would be extremely fast growth. So it's probably not up that high, but that's what current estimates indicate. Then if we do purchasing power parity, where we're essentially putting every other country's GDP into, like an equivalent amount of currency, like using the same cost for products that you would find in the United States for every other country, China absolutely dominates. China's economy would be about $31,227,000,000,000 as opposed to 17.96 trillion on that nominal basis. The US is, of course, still second place at 25. It would be the same for the US because we're kind of the standard setter. So this is a pretty interesting chart. I hope we can show it in the video. Maybe just cover up my face for a second, give all of your eyes a break. But otherwise, still, China, one of the fastest growers, the largest economy in the world if we're talking about purchasing power parity. Plus, this is a country that is investing heavily in actual developing economies. They're doing a lot of things like bridge building and port building in Africa and Central America, and going to a lot of these, kind of underdeveloped regions of the world and starting to invest in them a little bit. Kind of like what the United States used to do, but instead of overthrowing governments and making, banana republics out of everybody, it seems like China's actually doing their best, but there is some conundrums over getting them into essentially like debtor's prison or locking them into like these egregious debt contracts that countries like Somalia obviously can't afford to pay. Nonetheless, what's going on in China right now? Well, following the COVID pandemic, China was kind of the envy of the world. Their so-called zero C-19 policy seemed to be working out really well on both the health and the economic side. But after, 3 years of zero C-19, economic growth is really starting to deteriorate, even though China's health had largely upheld much better than the rest of the world, even though that's where the fucking virus started. But nonetheless, what we saw is that China had basically the exact problem as every other country in the world. Everywhere else, the United States, the UK especially, were experiencing multi-decade highs in inflation. The highest that China ever saw, at least on a monthly basis, was about 0.83%. So the United States, on a monthly basis, we were getting up closer to the 2% range or so, and that's what we want annually, definitely not monthly, but that's what it was when we were at that 9% annual inflation. China never got close to that level. Now they are dealing with the exact opposite problem. Starting in early 2023, deflationary trends started to be a huge problem, and as many of you wise apes are already aware, deflation is actually more concerning than inflation. Inflation means an overabundance of demand going after too few products. Basically, supply is too low for its requisite demand, so that's going to push the price mechanism higher. Whereas if you're in a deflationary trend, supply is outstripping demand, and that means the prices are going to continue falling. So if you're planning on buying something, you're just going to wait for the next month because prices will be lower. And then if it's not an essential item, I might as well just wait for the next month because it's going to be even lower. And then consumption stops and the economy falls apart, and I cry myself to sleep every day, even more so than I already do. So This is a big concern to be on the lookout for, and it kind of got a lot of eyes looking at China. So when you start to break down the numbers and see what's actually going on, we can see that one specific area is having a huge impact, and this is called the wealth effect. So with the wealth effect, we see this in the United States. We saw it in 2021, for example, when markets are absolutely ripping, when your asset values are increasing, you feel a lot richer. Your net worth is increasing on paper, and it kind of makes you feel like you can go out and spend more money. It's a great thing for economies like the United States that are extremely dependent on consumer spending. China is a little bit less dependent on consumer spending, but it still plays a huge role. What China is much more dependent on, though, is property value. So in the United States, roughly about 23% of any given household's net worth is attributable to properties and properties that they own. In China, it's nearly triple that amount. It's 62%. So the vast majority of wealth in China for Chinese households is held within properties. Well, can you guess what's happened to property values since the start of the pandemic, especially in China? In China's top cities, the top city average in China, I believe this is cities with more than like 25 million people or so in them, which in the United States there are exactly 0, but in China there are probably millions of those on their own. But either way, basically what we can see, the average property value in China's top cities has declined nearly 30% since the onset of the pandemic. 62% of their wealth in that is horrific. Can you imagine if the stock market returned to, 2015, 2016 levels here in the United States? Oh my God, you would have falling stockbrokers all over the country. You'd have to carry a fucking concrete umbrella to protect yourself. But in China, it seems like, obviously it's a little bit different because it's property markets and it's less like, it's not marked daily like it is here in the United States or like stocks are everywhere in the world. So it's a little bit, it's not a direct comparison, but it's about as similar as we can get. Some other statistics in China that are particularly concerning. According to reports from the National Bureau of Statistics, which I actually went on today on my computer, which probably means that I'm going to be part of the CCP within a couple of years. But either way, China's retail sales in August grew just 2.1% below the 2.5% estimate, and down from the 2.7% that they registered in July. On the industrial production side, expansion slowed to just 4.5%, missing expectations for the 4.8% and 5.1% that they saw in July. Fixed investment slowed markedly to 3.4%, below the 3.5% expected. And the investment in real estate was the worst part here. No surprises there. That was down 10.2% year over year. Much bigger problem, however, is arguably on the unemployment side. China is very shady about these figures here too, so take all of this stuff with a grain of salt here as well. It's probably, if anything, worse than they present it because it's the Chinese Communist Party and they're not exactly famous for their honesty and transparency. Unemployment rate of 5.3% was up slightly from 5.2%. This is urban unemployment because rural, like the demographic dynamics in China are much different than they are here in the United States. So they report urban unemployment 5.3% against 5.2% in July. Youth unemployment, however, horrific problem. I would love to be a youth over in China, especially one of the 18.8% of them that currently do not have a job. That sounds absolutely fantastic. That's up from 17.1% that was seen in July. It's the highest that they have ever seen since changing how this has been counted, which I believe they changed in December of 2020. Might have been December of 2023. I'm kind of blanking on that. But they started reporting this data for quite a while, presumably because it was so bad. But they're reporting it once again, so I guess it's not as bad as it is. But because of all of this action going on, the calls for continued stimulus in China are getting even louder than their fucking jet engines as they fly over the Strait of Taiwan. It's getting pretty ugly over there. China's already doing some stimulatory activities. Like, they got some real creative stuff going on over there. So first and foremost, Fed rate cuts actually help out China because it makes it easier for them to, kind of contain the yuan and not have to worry about its value too much because the US dollar is going to be declining relative to it, and that's kind of what they were trying to protect against. Some other stuff that they are doing, they've instituted a trade-in program where consumers can basically go and trade in their old goods for cash and go spend that on new stuff, new investment, whatever it is, just trying to spur some economic activity right now. There's a lot of other stuff going on as well. There's eliminated restrictions on foreign investment, local investment to create urban jobs. These local governments are kind of doing projects and everything like that so that they can hire people. There's increased defense spending, vouchers for spending. So it's basically the government is just giving all the money that they have to consumers. And this is largely what we saw in the United States immediately following the pandemic, but China decided to take its time a little bit. So we all know the expression, when the US sneezes, the world catches a cold. Arguably, that's even worse in China because, again, see the size of their economy on purchasing power parity basis, as well as their investments in developing economies. So it's arguably even more important. If those funds dried up, those developing economies would probably be even more screwed than they already are. But still, China is definitely in trouble. The government is doing a lot to stimulate the economy and try to, contain the trouble as much as they can. And that's why it was a big surprise last week when the People's Bank of China, they decided not to cut rates by another 25 basis points or so, like everybody and their mother thought they were going to, but they meet on a monthly basis, so expect cuts at the October meeting. All right, let's go ahead and get into some of our big stock movers of the day. First and foremost, we have Tesla. Pretty handsome day for Elon Musk Incorporation, up 4.93%. These guys, they are revving their non-existent engines as the Fed is cutting interest rates, lowering borrowing costs, and increasing appetite for vehicles, especially pricier vehicles, which I guess Tesla is kind of known for, but that wasn't really the attention today. Today, there was specifically Barclays analysts had the absolute hookup for the EV maker because analysts came out today and said that they expect deliveries for the third quarter to be much higher than they were in Q1 and Q2. So obviously, that's going to be a positive catalyst for the stock going forward. It's been a volatile year for Tesla. Now, over the past month or so, shares are up about 20% since the last trading day in August. But let's go ahead and take a look at the year-to-date chart. Yet stock is basically flat, up 64 basis points year-to-date. Still up big time from its April lows. Holy shit, yeah, it's up 75% since lows in April. So it's been an extremely volatile year. Who's surprised? This is Tesla. You know what you're getting yourself into, but at least they had that near-term positive to hopefully look forward to. Fingers crossed if you're a Tesla bull. Boeing, nobody is a bull on Boeing. Give me a fucking break, and rightfully so. Jesus Christ. There's a lot going on at this space and aircraft maker right now. Yesterday, none of it had to do with falling doors and planes crashing into the sides of mountains because they're fucking their in-flight software system, where when pilots press take off and then they take off and then cruise and it cruises and then land and it lands. Apparently that wasn't working too well for them, but I guess they got it all fixed up. Boeing's internal space and defense CEO, a man by the name of 𝗏𝗏, pretty handsome looking fella, he was forced out of the firm. They already have a replacement set up for him. I mean, after stranding astronauts at the International Space Station for an additional 5 months longer than they were supposed to be, and then needing Elon Musk, see again Tesla, to come in and rescue these astronauts. It's not hard to understand why they had to boot this guy out of there. But there was also some good news on the strike side. Well, hopefully good news, because Boeing came back with what it claims to be its best and final offer to get machinists off the picket line and get them back in the factory, sweatshops, whatever you want to call them. It's estimated that the strike is costing them $50 million a day, so the additional news that it might be closer to ending sent shares a little bit higher, in addition to the management shakeup. Qualcomm was down 1.75% here today. They just fucking spit on a dead body is essentially what they did, kicking them while they're down. Qualcomm basically just did the corporate equivalent of waving a $100 bill in a homeless person's face, because on Friday, heading into this weekend, Qualcomm apparently reached out to Intel and offered to take over the company. Now, that is the biggest flex that I've heard in quite a while. Qualcomm has a market cap of over $180 billion. Intel is about $96 billion. So because these companies are larger than my dad's one-man construction company, I'm sure Lina Khan is going to absolutely hate this, because she does not like people to have fun, make money, or especially to make mergers. So Lina Khan, I mean, the odds of this deal going through are about equivalent with the odds of Lina Khan actually winning a court case, which is, see again, 0%, walking L Lina Khan. But still, no doubt the aforementioned FTC chair, she would have a big problem with this kind of merger. I think Qualcomm knows that, and they know that they're not actually going to take over the company. Probably wanted to arouse some ire in their competitor, but that would probably strengthen domestic production of chips and semiconductors and all that other stuff. So, maybe it's something worth considering. But do we want an oligopolistic economy? Maybe. I don't know. I guess we can see what happens. Before we find out, though, let's go ahead and talk about General Motors stock. Shares were down 1.72% on the day, exact opposite of what was going on over at Tesla. That's because whereas Barclays had the hookup for Tesla, Bernstein had the exact opposite. They had a nice knuckle sandwich for GM here today. They chopped their rating on the stock from buy to hold, but they only cut their price target from $54.50 to $53. Grow some fucking balls. Make an actual statement over there, fellas. Stock is at $48.04. So what's that going to be like? Basically like a 6%, 5.5%, 6% or so increase. I mean, I guess that's why they downgraded it to a hold, but who cares? Make an actual statement with your price targets. Take some risk with it. Have some fun. Who cares if we're wrong? I mean, everybody's wrong once in a while, right? But either way, the concern is that unsold vehicles are piling up a good bit because the company loaded up on vehicles in the past couple of years and they're having trouble getting them the fuck out of their lots. So they're worried that they're going to have to start to incentivize sales through price reductions, increased discounts, and all of it basically just threatening margins going forward. All right, that does it for our stock movers, but we do have one more thing to talk about here today. We are going into some pigs and pills. I just found out today that the Danish economy actually does export and produce more than just a delicious breakfast pastry. This is news to me, but again, Denmark is one of the world's leading exporters of a lot of different things. Specifically, pigs is a big one, live pigs, in addition to dead pigs, aka pig meat, and pharmaceuticals. Now, selling pigs is crucially important, obviously, but Denmark relies on selling pills almost as much as their users rely on popping them. So it's a little bit kind of shaky ground for the economy because of how much they rely on selling these pills. Let's talk about exactly how strong that reliance is. According to recent data published by our favorite certified smarty pants, Mr. Torsten Slok over at Apollo Global Management, who also actually recently is kind of trying to make a huge investment in Intel, by the way, which we'll probably talk about tomorrow. 70% of Denmark's GDP growth is directly attributable to the pharmaceutical industry. So again, 70% of Denmark's GDP growth is directly attributable to pharmaceuticals. Now, if we break down the industry a little bit more, we can start to see that there is one big, huge, giant, major player that basically drives all of that. Novo Nordisk is effectively the modern-day equivalent of the British East India Company, but for Denmark. This is a $420 billion stock, roughly around there. Denmark's GDP in 2023 was about $400 billion, so the company is larger than the country itself in terms of its economic value. It's actually even estimated that in the first quarter of 2023, the pharma industry, and in other words, Novo Nordisk, accounted for 89% of the country's GDP growth during that period. So this is heavy reliance on this one singular company. But if we start to break it down even more, the reliance gets even more extreme, like to the point that it's borderline negligent. Like in 2023, like I said, Novo Nordisk was about 70% of total GDP growth, but they were also about 20% of total job growth. So Novo Nordisk was responsible for about 1 in every 5 jobs created in 2023 within Denmark. Now, that sounds pretty bad in and of itself. But what if I told you that the company was more than 50% reliant on just 2 products? Well, they are. If you add up sales of Wegovy in a little drug called Ozempic, have you heard of it? That's about 55% of the company's total revenue. Now, if we take out Wegovy, we get to 42.7% of Novo Nordisk's total 2023 sales attributable only to Ozempic. Now, that is concerning. Obviously, it's great to have a blockbuster breakthrough drug, but when your entire economy relies on this company so much, and this company relies so much on just one product, you're setting yourself up for disaster, because the risk there is that, Ozempic sales slow down, like we saw with Tylenol back in the day with J&J when they found or baby powder with J&J too. They found all these, miscreant products that were contained within this stuff, basically contaminated them, and nobody would buy them for months and months at a time. If that happened to Ozempic, Denmark might fall into the what is that? The North Sea? Is that the Atlantic Ocean, or is that what ocean? My geography teachers would kill me. I swear to God, I'm good at geography right now, but what ocean would that be? Like the Arctic Ocean, I guess? They're probably going to fall into that if sales of Ozempic slow down enough. But I guess that's why they sell us so many of those delicious breakfast pastries, is so that we're all obese, so that they can keep selling us Ozempic. But then again, if the Ozempic works too well, then nobody's going to be obese and nobody's going to need Ozempic anymore. So hopefully they can, come up with a drug that maybe helps human beings find meaning in the digital age, because it seems like that would help out quite a lot more than just obesity in itself. All right, that about does it for us here today. We want to leave you guys with a quote from one of my personal favorite finance authors of all time, 𝗪𝗏 He wrote a great book that's called The Misbehavior of Markets. I couldn't recommend it enough. It's a little bit math heavy. Don't worry, I was never the best at math. I could only go up to AP stats, which is basically where I capped out. If you talk to me about calculus or anything like that, I'll throw up and cry. But 𝗪𝗏 said, rule number 1, markets are risky. Rule number 2, trouble runs in streaks. Rule number 3, markets have a personality. Rule number 4, markets mislead. And rule number 5, market time is relative. So a great quote from 𝗪𝗏. That's a lot to take in. I'm not going to break it down here because we're already at 24 minutes. Instead, what I'm going to do is thank you all for joining me here on the world's most popular and influential podcast. And I will see you all tomorrow. Happy investing, happy trading, and bye now.